In uncertain times, such as these that we are currently living in, being tax smart and investing optimally can go a long way to improve one's financial outlook. And as Benjamin Franklin once said, there are only two things in life that is certain: death and taxes. And unfortunately, South Africa is among the top 10 most heavily taxed countries in the world. And unfortunately, for most of us, one of our biggest expenses is not food, traveling or housing, but taxes. Now, we can either continue to complain about it, or we can learn what we, as ordinary taxpayers, can do to help reduce our tax bill. Now, there are basically two ways in which we can save tax: tax avoidance, which is legal, and tax evasion, which is illegal. So in this video, I will be giving you the top 7 ways on which you can reduce your tax bill in a legal manner, of course, that can easily amount to saving you over 6 figures over the long run. First up is contributing towards a retirement fund. Now, retirement annuity, or short RA, is basically like an investment account in which you can put things like an ETF, unit trusts, bonds, or even cash. Now, the great thing about RAs is that they are exempt from capital gains, income and dividend tax. So basically, the money that you put into an RA is deductible from your taxable income. Now, there is a limit of 27.5% of your gross income, or a maximum contribution of 350,000 Rand per year. Now, this limit applies to the total contributions made to any pension, provident or retirement annuity fund. Pension and provident funds are usually paid by your employer, and you'll be able to see this on your payslip, but you can then also top up your retirement savings by contributing towards a retirement annuity. Now, if you exceed the contribution limit for that year, then the excess will simply be carried over to the next year. And just one thing to remember is you cannot access these funds until you are at least 55 years old. This is a great way to save for your retirement whilst reducing your taxable income. So let's look at a quick example. If you, for example, earn 350,000 Rand gross income per year, this will put you in the 31% income tax bracket for this current financial year. Now, if you invest 15% of your gross income, which is around about 52,500 Rand into your RA, you will only be taxed on the difference. So basically 350,000 Rand minus 52,500, which is 297,500. Now, if you are an employee that already paid tax on the 350,000 Rand, for example, by means of a pay-as-you-earn, you will get a refund equal to your RA contribution times your tax rate. So for example, 52,500 times 31%, which will equal 16,275 Rand. This is basically free money, and thus your 52,500 contribution now only costs you about 36,225 Rand effectively. The second best thing you can do is to open a tax-free savings account. Now, this works very similar to an RA, in which you can invest in different financial products such as ETFs, unit trusts, fixed deposits, bonds, property, etc. Now, the great thing about this is that all returns, including the capital gains, dividend and income earned from your investments, are tax-free, which basically means that you will not be liable to pay tax on either the growth of your investment or when you withdraw money from your account. Now, there is currently an annual contribution limit of 36,000 Rand per year, as well as a lifetime contribution limit of 500,000 Rand. And this annual limit can be spread amongst many different types of tax-free savings accounts. Now, there are 3 very important things to know about a tax-free savings account. Number 1 is that the annual limitation cannot be carried over into the next tax year. Any unused amounts will be forfeited, and the new limitation will be reset at 36,000 Rand. So, for example, if you only contributed 30,000 Rand instead of 36,000 Rand for that year, then the next year you won't be able to contribute 42,000 Rand, as this new contribution limit will be reset to 36,000. The second thing is that any excess amounts that are above the contribution limit will be taxed at a rate of 40%. So, do not make that mistake. If you have more money to invest, then great, put it in your RA, but do not exceed the 36,000 Rand. And this can become quite confusing if you have multiple tax-free savings accounts, so make sure to monitor the contributions to each one of these. And the third thing is You are more than welcome to withdraw money at any time from a tax-free savings account, but the replacement investment amounts will then be seen as new contributions and will therefore count towards your annual and lifetime contribution limits. So again, say for example, you invested 30,000 Rand, you withdraw 10,000, then the maximum that you can add again for that year is 6,000, not 16. Okay, so let's look at another example. Let's say your tax-free savings account is invested into the stock market. We assume a 6.5% return after inflation on your investments. Now, if you start at 51 years of age, you invest 3,000 Rand per month for 14 years, you will reach your maximum contribution of 500,000 Rand. And when we include the growth over this period, you'll end up with an investment of around about 818,000 Rand. Now, if you start from 18 years, you invest 3,000 Rand per month for 14 years to reach your lifetime contribution limit, and you just leave your money there to gather compound interest for another 47 years until you're 65 years, your investment would have amounted to a total of 6,953,115 Rand. What is even more awesome is that you will not be paying any dividend withholding tax, which is usually around 20%, or capital gain tax, which depending on what type of tax bracket you fall into, can be as high as 45% on your investment. So you will effectively save hundreds and thousands of rands over this period. And if you use the 4% rule of retirement, you will be able to live comfortably on 23,177 Rand per month just from this one investment. The third thing you can do is to join a medical aid scheme. Now, as part of the medical scheme's fees tax credit, SARS will give you a fixed monthly tax credit of 319 Rand for you as the primary member, 319 Rand for your first dependent, and then 215 Rand for each subsequent dependent if you are part of a medical scheme. Now, this is a flat rate per month, does not take your taxable income into consideration, and is a direct reduction of your tax liability. So for example, if Kwesi pays for medical aid for himself, his wife and 2 children, his tax credit will be calculated as follows: 319 Rand for Kwes, 390 Rand for his wife, and 215 Rand times 2 for his 2 children. Now this will equal 1,068 Rand of tax credit per month, and therefore Kwes's tax liability will be decreased by 1,068 Rand per month, and thus 12,816 Rand per year. Now, if your tax liability is greater than your medical tax credit, then you will basically receive a refund for the difference from SARS. But if your tax liability is less than your medical tax credit, then your tax liability will basically then be reduced to 0, meaning you will not owe SARS any money, but the difference then will not be refunded. Okay, so the fourth way is to donate to a registered SARS charity. Now, a public benefit organization, also known as a PBO, is a non-profit organization that is registered with SARS that is exempt from paying tax on the donations it receives. Now, these organizations are usually involved with charity work such as healthcare, education, animal welfare, religion, conservation, and a couple of other things. Now, contributions to a registered PBO are tax deductible up until 10% of your taxable income. If you exceed this limit, then it will just be carried over to the next year. Now, this is kind of a great way to contribute towards a good cause while also reducing your tax bill. I will leave a link to a list of registered PBOs in South Africa down in the description so that you can go check it out if you are interested. Number 5 is to keep a logbook if you receive a travel allowance. Now, a travel allowance is a taxable fringe benefit, which means it will be added to your taxable incomes and you'll need to pay tax on it. Now, SARS generally assumes that we use our car to drive 80% of the time for personal reasons and only 20% of the time for business purposes. So, if this is not the case, then keep a logbook to record your business mileage, as you can then claim a travel deduction against it and lower your tax liability. Now, here is a handy vehicle logbook app that you can use, and I will also link to it down in the description. Number 6, claim commission-related income. If you are a commission earner, such as a financial advisor, a travel agent, or a real estate agent, and your commission income makes up more than 50% of your total remuneration, then SARS will allow you to deduct your commission expenses against your commission income. These expenses may include things like cell phone bills, stationery and fuel. Now it's really important to keep record of all of these expenses with their related invoices so that you'll be able to provide proof in case SARS decides to audit you. And finally, number 7, claim expenses if you are self-employed. Now, if you are an independent contractor, a sole proprietor or a freelancer, then SARS will allow you to deduct all your business-related expenses against your business-related income. So basically, all the expenses that you incurred in order to generate an income. These expenses will once again include things like cell phone contract, data, fuel, car maintenance costs, and if you are working from a home-based office, you may even include things like utilities, rent, and cleaning supplies. Once again, make sure to keep a record of all of these expenses so that you'll be able to have your back in case SARS, decides to audit you. Now you may be asking, Peter, what am I going to do with all this extra money? Well, it's simple. You reinvest your money and you watch your savings grow and compound over time to massively boost your retirement income. Now guys, I am not a financial advisor. I'm just another ordinary guy on the internet trying to improve his own personal financial future whilst sharing the knowledge that I gain. You must always consult with a registered tax practitioner to decide where you need to put your money. But I do strongly believe that it is very important to educate yourself on personal financial matters because, let's face it, school didn't really teach us these things. And the more you learn how the system works, the more you learn how you can lose less. You, and only you, are responsible for your personal financial future. And this is kind of what this channel is all about. So if you would like to see more videos on personal finance, investing, entrepreneurship, or life hacks in general, make sure you subscribe. And if you found this video to be helpful, I'd really appreciate it if you can leave a like on this video for the YouTube algorithm to help it show to more people. And let me know down in the comments which one of these have you tried in the past and how they worked out for you. And I also have quite a lot of other videos that can help you to save money, so please check them out down in the description. And as always, have a lekker day and I'll see you in another video next week. Cheers!